Hey everyone, welcome back to another video. In today's video, I have a company here that is currently trading below intrinsic value per share in the stock market, and that is Albertsons. And so in this video, I'm going to look through their financial statements and then also use a discounted cash flow model to figure out the intrinsic value per share for this company, so we can know if $26.43 per share, give or take, is a good buying price to buy into this stock from a value investing perspective. And so we can see that over the last year, Albertsons is down 7%, while the S&P 500 is down 20%. So they are outperforming the market at the moment. And for anyone who doesn't really know what Albertsons is, essentially it's a leading food and drug retailer in the United States. And as of the end of the first quarter of 2022, they owned and operated about 2,273 retail stores across 34 states in the United States of America. And so right here, we can see their balance sheet for their first quarter of 2022, their results ending June 18th, 2022. And we can see that their total assets have increased from about $28.1 billion to about $28.2 billion. And then if I scroll down a little bit here, we can see on their balance sheet that most of their business is financed by equity as opposed to liabilities. Most of it's financed by liabilities as opposed to equity, They have about $4 billion worth of total stockholders' equity, which means that their total liabilities come out to be about $24 billion. And on top of that, we can see something interesting here, which is that their total stockholders' equity additional paid-in capital account has actually decreased, which means that they haven't been issuing as many shares as they have in prior periods. But yet, as a result of that decrease, their total stockholders' equity has increased, and that's came mainly as a result of a very large increase in their retained earnings line item here, from about $2.5 billion to $2.9 billion. So that's obviously a good sign because it means that the business is growing as a result of earned capital, as opposed to their equity position increasing as a result of contributed capital from outside shareholders, which would have diluted the equity for the prior shareholders who were holding onto shares of Albertsons before that. And so if I scroll down here to the next page, we can see their income statement or their statement of comprehensive income. And we can see their total revenues have actually increased year over year for the period ending June 19th, 2021 to June 18th, 2022, from about $21.2 billion to $23.3 billion. And then I know it doesn't say it here, but in another part of their report, they pointed out that same-store sales, so basically sales for each of their store locations, had actually increased 6.8% due to retail price inflation. And also their digital sales on their website increased about 28%. So both their retail and their online presence is growing. And we can see right here their gross profit margin increased, or not their gross profit margin, but their gross profit increased from 6.1 billion to 6.5 billion. But if you do the math and calculate their gross profit margins here, you would learn that their gross profit margin actually decreased from 29.1% to 28.1% year over year. So that means that their cost of sales to get this net revenue amount, this increase in net revenues, increased faster than the actual revenues did, which isn't really a good sign, but we'll see if their gross profit margin increases in the future. Also, if we look at their bottom line here, their net income, we can see their net income grew from about $444.8 million to $484.2 million. So that's an increase of about 8.2% year over year. And then we can also see that their earnings per share increased from about 78 cents per share to 84 cents per share, which is an increase of about 7.7% year over year. And so we're seeing that their earnings per share increased less than their net income increased. And that's basically showing us that the amount of shares outstanding in their company increased during the same time period, which is why their earnings per share didn't increase as much as their net income increased. And the last financial statement I want to look at here is their cash flow statement. And we can see that their net cash provided by operating activities decreased year over year from about $1.05 billion to about $991 million. And we can see the main line items that contributed to that decrease are inventory and accounts payable. We can see they purchased a lot more inventory in the first quarter of 2022 compared to the first quarter of 2021. In the first quarter of 2021, they had a cash inflow of about $14 million from their inventory. But in this quarter, 1 year later, they had a cash outflow of about $134 million. So they purchased $134 million worth of inventory, which could be a good sign because obviously once they sell that inventory, they're going to increase their revenues and their profits. But also we can see that they're reducing the amount of money they owe to their suppliers in the way of accounts payable. So they repaid their suppliers to the amount of about $123 million, which was only about $31 million for the first quarter of 2021. And so this could mean something, but it could also mean nothing because obviously when they report these financial statements, it's all about timing. So just because in the first quarter of 2022, they're reporting higher inventory purchase and higher accounts payable purchased than in the first quarter of 2021, it doesn't mean that for the entire year of 2021, they incurred less business expenses than they did for 2022. It could just mean that for the first quarter of 2022, they incurred more expenses, which is why the net cash provided by operating activities is lower at the moment. But this could even out as the rest of the year's business operations plays out. And the last thing I wanted to look at here is their cash flows from financing activities. We can see here how they're returning value back to their shareholders in the way of dividends paid on their common stock to the amount of $63 million, which is up from $46.5 million year over year. So they're prioritizing returning value back to their shareholders a lot more this year than they were last year. And we can also see that in their financing activities, they don't have anything that points out that they're repurchasing shares of their common stock at the moment. And so what that basically means is that if we look at the 5-year chart right here, they went public pretty recently, as we can see right here, but they are up about 60% since they went public in June of 2020. And all of this growth has not been attributed to repurchases of common shares. It's mainly just been attributed at the moment to just the growth of their business. And so if in the future they do start repurchasing common shares, and that will accelerate the growth of their common stock even more than it already is. So definitely interesting to see how, although they aren't repurchasing shares like a lot of other companies do, their stock price is still increasing a lot, even more so than the overall market, which is only up about 30 to 40%. And so what I want to do now is look at this discounted cash flow model to figure out what the intrinsic value per share for Albertsons is. And so I got these growth rates and some of these other metrics from Yahoo Finance. Basically, analysts on Yahoo Finance are estimating that the future growth rate for Albertsons is extremely low at only about 0.06%. And so I cut that value in half to 0.03% for the next 5 years after that. But interestingly enough, even with these extremely low growth rates, we can see that once we take into account the fact that they had $2.5 billion of free cash flow in 2021, and they have a net debt position on their balance sheet of about $10.8 billion with about 531 million shares outstanding. Once we take these metrics into account, we can see the intrinsic value per share is estimated to be about $26.90 per share, which compared to their current share price means that Albertsons is trading below their intrinsic value per share at the moment, since they're trading at $26.43 per share. But it's really interesting to see that even with a growth rate as low as basically below 1% per year compounded annually over the next 5 to 10 years, their intrinsic value per share is still higher than their current trading price. And so basically, if Albertsons manages to grow faster than 1% per year for the next 10 years at any point, then that means that this puts the intrinsic value per share for their company even higher, which would mean that Albertsons is trading at an even steeper discount than we might be able to originally anticipate. Because let's say I boosted this growth rate to something like 10% and then made it 5% for the next few years after that. You can see that boosts the intrinsic value per share for Albertsons up to $53 per share with a 50% margin of safety of $26 per share, which would mean that Albertsons is basically trading at a 50% margin of safety if their company grew at about 10% or 5 to 10% over the next 10 years. But we can see that Yahoo Finance is estimating that they're going to grow at less than 1% over the next 10 years. And even with such a conservative growth rate estimate, Albertsons looks like they're still trading below their intrinsic value per share. So that's pretty rare to see for a company, because pretty much any other company on the stock market, if you punch in a low growth rate like this for their valuation, less than 1%, their intrinsic value per share is not going to be higher than their current trading price. So the fact that Albertsons is pretty interesting. And so that's definitely something that's very intriguing about this stock valuation. And so on the right-hand side here, we can see I did a competitor analysis comparing them to other companies in their industry. And we can see I compared them to Walmart, Target, and Kroger. And when we look at these different business efficiency ratios, we can see that Albertsons has the second highest gross profit margin at about 26%, right behind Target's 27%. But we can also see that in their comparisons for net profit margin and return on assets, Albertsons seems to be a little bit more middle of the pack at about 2%, right near Walmart. But Target seems like they have the highest business efficiency ratios out of all of the companies in this industry. And so looking at that made me wonder if Target or any of these other companies also present buying opportunities that may or may not be stronger than the one that Albertsons presents. And so I ended up doing an intrinsic value analysis for all of the companies, but the ones that were trading below intrinsic value per share were Target and Kroger. Walmart was trading way above their intrinsic value per share. And so we can see that according to Yahoo Finance, Target is going to grow at about 20% for the next 5 years. And so I was conservative and I cut that in half for the next 5 years after that. And based on that, you can see the intrinsic value per share for Target is estimated to be about $225 per share. And so if we look at their stock price, they're currently trading at about $145 per share, down about 40% this year. And so that puts them at less than a 30% margin of safety compared to their current intrinsic value per share. And then also, if we look at Kroger, we can see that based on the estimates from Yahoo Finance, that their intrinsic value per share looks to be about $66 per share. And Kroger is currently trading at $43 per share, up 10% over the last year, in the same year that the S&P 500 is down 20%. So definitely outperforming the market way more than Target or Albertsons. But we can see trading at $43 per share puts them at less than a 30% margin of safety compared to their intrinsic value per share. But keep in mind, even though Kroger and Target are trading below 30% margin of safety compared to their intrinsic value, you have to keep in mind that the growth rates that are projected for these companies are about 20% and 10% for Kroger, whereas for Albertsons, it was less than 1%, and they were still trading below their intrinsic value per share. So if I mimicked the growth rates for Albertsons and then estimated them for Target and Kroger, we can see that with those estimates, it would look like neither Target or Kroger are trading below their intrinsic value per share. Both would be overvalued if we were to use these growth rates, the same ones that Albertsons are using. So it's definitely interesting to see how these companies compare against each other. It looks like, based on the estimates from Yahoo Finance, that Target and Kroger might be trading at a better price at the moment compared to their intrinsic value per share, but you would have to take into account the fact that their growth rates are a lot higher than Albertsons. So I'm not sure which of these companies are trading at a better buying opportunity right now. All I can say or really gather from this analysis is that obviously from a business efficiency standpoint, it looks like Target presents the best buying opportunity since they have the best business ratios. But from an intrinsic value analysis perspective, I would probably put my money on Albertsons, mainly because the growth rate for their company projected into the future is way lower and way more of a conservative estimate. And even with that conservative estimate, they present a pretty strong buying opportunity. But also from a stock performance perspective, we can see over the last 5 years, Target has performed the best at 141%, whereas Kroger is only at 100%, and Albertsons, being that they recently went public, is only up about 60%. And then over the last year or so, all of these stocks are down except for Kroger, which is up 10%. So it would look like from a stock performance perspective, it's either Target or Kroger. From a business efficiency perspective, it's probably Target. But then from an intrinsic value perspective, it looks like it might be Albertsons. So a lot of things happening here in this video. Probably going to be keeping my eye on all three of these stocks, especially Albertsons, because of that really conservative growth rate that makes it seem like they could be a potential attractive investment. But I'd love to know what anyone watching this video thinks about these three companies, or mainly about Albertsons. Is it a good buying opportunity right now? Let me know in the comment section down below. Leave a like on the video, subscribe to the channel, and I'll see everyone in the next one.